So how does a homeowner who has $200,000 of equity in their property that has grown from the time that they purchased it not be able to afford that home anymore? Well, the reality is that more and more Calgarians, when they're coming up for renewal and they're trying to sort out their finances, just can't afford the current home they have. And to be honest, this is kind of confusing. So I ask you, how can someone not afford their home if they've had that much value increase over the time? Over the past number of months, our team has had incoming calls like this from our clients and from this YouTube community that we are building. We've been able to help them with the right connections with the mortgage professionals to sort out a way to make it work. And there have been times where we have had to help that client sell the home and find a new one. At the end of 2023, we had someone who reached out to us who was in a situation like this. She had bought a property with her husband, and about 15 years ago, they paid roughly $400,000 for it at that time, and since then, they have gained almost $200,000 or just over $200,000 of equity since they purchased. So how does someone like that go to not affording it? Her situation's a little bit different. Her husband had passed away. They went from having income to now being on a pension and retirement income, and so her life had really changed. But it's not just people who are going through situations like hers that are experiencing this issue of not being able to afford their home, even though there is such a huge growth of equity that has happened. So what's going on? What is happening? Let's go take a look at the numbers. So I'm going to share with you a little bit of an insight of how this is happening here in our mortgage calculator to understand kind of what happened. Because this lady's individual scenario is kind of a little bit uncommon because, I mean, it's aging populations, passing spouse. There's a lot of things that you would look at that and go, okay, that makes sense. She can't afford it because now there's only single pension income versus, working income from two people when they bought the property. But what happens if you kind of have median income and you even increase the income that you're making from the last 5 years and property values go up? What does that look like? So what I did is I went down to Mackenzie Town and I found kind of a basic starter property, around 11 to 1,300 square feet, 2-story. And they at the time were selling for around $330, $320 to $350, somewhere in there. And in 2019, you can see in this situation, we're going to put down 10%. Okay, so they had 10% down, they paid their CMHC, the 306 was their mortgage on a 330 purchase. In 2019, they had a 5.34 fixed 5-year interest rate. So when you look at this, this isn't rock bottom interest rate. So this isn't even a situation where you have like a 1.8 or a 2.2 interest rate mortgage. This is actually 5.34. They did an amortization of 25 years and they don't have any condo fees. And they kind of had insurance of $1,400 and their annual property taxes of $2,200, but $184 a month. And so their total cost per month right here is $2,141. Now, if we look at the mortgage rules, they're 39% of what they make. So they made $67,000 in that year. So probably let's just say it's a single person or two people, maybe a part-time and a full-time, or an individual, or maybe one spouse is staying at home, the other one's working. There's lots of different situations that could come in here, but about $67,000 after taxes, bringing home about $38.50 a month. So right now they qualify with a 39% GDS, right, gross domestic ratios that a mortgage broker would give them. So they bought at the top end of their range. Now let's fast forward to 2024, because what that looks like is a little bit different. So I went to Mackenzie Town again and I looked at the properties there and said, what type of property, what is this property selling for now? And I found that there were a lot of properties in the last couple months that had finished basements. So I said, you know what? COVID happened. A lot of things happened over that 5 years. And this family, individual, couple, single person, whatever it was, decided to do the basement. But over that time, they saw their equity increasing. So they actually took money off of their mortgage and they ended up putting that towards a basement. So maybe $40,000, they developed the basement because the $330 price before was an unfinished basement. So now those properties are selling for about $560. So right now, if they took out $40,000, their mortgage would be roughly about $315 to $320, and they would have $240,000 of equity in their property because it grew so much over the 5 years. Interest rates right now are 5.6. So let's say they're renewing at 5.6, and they're doing a 20-year amortization because they've already had 5 years that have happened. So property taxes, they're paying about $3,700 for the year, insurance about $1,800. So all in, their total cost now when they refinance is going to be $2,660. But when you look at this, the 39% didn't work, even though the income increased by $10,000 per year. The max amount that a broker would approve them for is $2,503. I mean, this situation, someone can easily make some tweaks on the back end and get out of it, because if you just go to 25 years on your amortization, well, that'll bring your mortgage down. So this situation can work, but this is how people are still buying at the top end, even though they have $240,000 of equity. It's just wild because of some of the increased costs. More of your actual cost of living going to the life that you want to have, whether that's entertainment, whether that's food, just the appreciation and the inflation that has happened in our economy right now, even though you have all of this equity sitting there. So is this what we are calling and what people are feeling when they say, I'm living house poor? And the reality is yeah, you're living paycheck to paycheck. You're at the top end of what's happening here again. So if you are in a situation where you want to try to figure out, what is this going to look like when we come to renew? Are we going to make a change? Are we going to upsize our property because we have the finances to do that? Are we going to downsize because we can't afford where we're living right now? Or we need to refinance to make all of this kind of work and come together? Well, the reality is we have a tool called HomeBeat, and this can really help you understand your current market value. What the city sent you and your city assessed value is not necessarily what someone is willing to pay for it. Our market values are increasing quite quickly and changing every single month. So if you want to get a HomeBeat set up, if you want to have conversations about what to do in this situation because the anxiety is rising and it's just not feeling like things are working or making sense anymore, and you're in a situation like this, then we should chat. We can connect you with mortgage brokers. We can connect you with finance individuals who can help you figure out what to do. And ultimately, if you do need to make a move, we want to help you make the right decisions and the right transitions, and do that in a way that is going to help you not feel like you're house poor and just trying to live from paycheck to paycheck just to pay for your property. And if you're finding this helpful, you're also going to find this video helpful too.